Welcome to the Evolution Partners podcast, where I talk with the world's leading thinkers, planners and doers who are helping to build great companies in their own way. We learn how the work they're doing is creating an impact and get to know a little bit more about them and what makes them tick. This episode is brought to you by Evolution Partners, where we help leaders to confidently build enduring great companies using our proven, structured, strategic planning process that ensures you build and execute the right plan. Check us out at evolutionpartners.com.au. Also, you can check out our books, Made to Thrive, outlining how to be a great CEO, as well as Onboarded, which is about making your new hires more effective faster. Hermann Simon is a thinker and a doer. He's the founder and honorary chairman of Simon-Kucher Partners, a pricing consultancy with 2,200 people worldwide in 47 offices across 30 countries. He's an expert in strategy, marketing and pricing, and he is the only German in the Thinkers50 Hall of Fame, highlighting the most important management thinkers in the world. Simon has published over 40 books in 30 languages, including the worldwide bestsellers Hidden Champions, Power Pricing, Confessions of a Pricing Man, as well as Manage for Profit, Not for Market Share. The Economist wrote that his firm, Simon-Kucher, is the world's leading pricing consultancy, and an ongoing online survey voted Hermann as the most influential management thinker, second only to Peter Drucker. You can find Hermann at hermannsimon.com. Hermann, thanks for joining me today.
Brett, I'm looking forward to our discussion.
Thank you, me too. Let's start, if we can, with profit, something that some people leave to last. In your book, True Profit, you quote Peter Drucker stating, "Profit is the cost of survival." You then go on to say profit should not be a residual that hopefully has a plus sign at the end of the year. Profit should be factored in upfront like cost in order to secure the company's survival. Tell us more, if you can, about the importance of profit and where you've seen entrepreneurs fail when they think about profit.
Yeah, I think that Peter Drucker's statement, "Profit is the cost of survival," brings it to the point, hits the nail on its head. And the strange thing is that in recent years, many companies built their strategy on not being profitable, but raising money from the outside, doing an IPO, selling the company. The most prominent example is WeWork. They got huge sums, billions of dollars from the Japanese SoftBank investor, and then they eventually went bankrupt. And I think the only long-term way for a company to survive is to become profitable. Not necessarily in the first couple of years, but in the longer term, you must become profitable. And as I said, please consider profit as a cost which you have to earn. So don't hope over the course of the year that a positive sign comes out at the end, but be aware for every day that you stand between the cost and the revenue and keep the two apart.
Yeah, so often you say that, and I get the sense that there is so much experience behind that. Profit shouldn't be, hopefully, a plus sign, having seen it, I suspect, so many times. So how do you think that entrepreneurs fail when they think about profit in their mindset?
Yeah, because, for instance, they have wrong goals. That growth is what drives them, or volume. Yeah. And that even happens to large corporations. For instance, Volkswagen for years had the goal to sell more cars than Toyota. And they eventually achieved that in 2018, 2019. But their profit, their margin was only half that of Toyota, and also the market capitalization was only half that of Toyota. So what is the meaning of such a goal if you are not making more profit, just selling more cars? You measure your success by units or by revenue. These are the wrong measures. Profit should be your key performance, your outstanding key performance indicator.
It's
Especially with the long term, not with a short term orientation, but with a long term orientation. So you could call it sustainable profitability, long term profitability as the only meaningful goal of a company.
I agree. And it can be a bit of an ugly word, or a word perhaps that some people who perhaps don't understand the importance of it can be reluctant to. I can remember speaking with an entrepreneur in Sydney recently, and I spoke to them about improving their profit, and they were like, "Oh, I don't know about that." But it's so important, don't you think?
Yeah, if you want to make yourself unpopular in a group, you advocate for profit orientation or profit maximization. That's a sure way to become hated by some people.
Real quickly.
And the other side is, what do normal people think of profitability? I did myself a study here in Bonn, Germany, and there are many studies also in other countries. And I asked the following question. If a company takes in 100 euros or $100, if you deduct all costs and taxes, how much remains? The average answer in Germany is 22%, what people think. In the US, it's even higher at 31%, and the record holder is Italy with 38%. The actual numbers are as follows over many years. In Germany, between 3 and 4%. In Italy, a little higher, and in the US, around 5%. So the perception of people about profit margins is wrong by a factor of 6 to 7. I have no explanation for this, but it's a total misperception, a misunderstanding of what a company makes in terms of profit, what the economy is like. It's strange. And of course, from these unrealistic perceptions, attitudes develop that entrepreneurs are envied, that profit becomes a bad word, etc.
Can you tell us about the 3 profit drivers and that you write about in your books, and which is the most important one?
Yeah, the formula is actually quite simple. Profit equals price times sales volume minus cost. So you have only 3 profit drivers: price, volume, and cost. And if you now think of improving each profit driver by 1% without any change in the other, so you can increase price by 1% and you don't lose volume, etc. Then price is by far the most effective profit driver. A 1% price increase, usually for a typical industrial product or service, leads to a profit increase of 10%. So the profit multiplier of price is 10. On the average, it varies, of course, from industry to industry. For costs, it's 6. So 1% decrease in cost typically leads to a 6% increase in price. And for volume, it's only 4. Why is it so low for volume? Because if volume goes up, marginal costs go up. If you sell more, if you produce more, your costs go up. This cost increase typically eats up a lot of your revenue. The profit multiplier for price is 10, for cost it's 6, for volume it's only 4. Price is the most effective profit driver.
I'd like to quote you now. Pricing is not primarily about price. Pricing is about the value perceived by the customer. In other words, price equals value. How can entrepreneurs understand the importance of value in setting price?
This is the fundamental equation of pricing, and the reason is the following. The willingness of your customer to pay a certain price depends on the customer's perception of value. if the customer perceives a higher value, then he or she is willing to pay more. The value may come from the quality of the product, from the innovativeness, from the brand, from your service. So there are many value drivers. And the Romans in their Latin language were really smart because they have the same word for value and price, namely pretium, like in precious. And so the core competence of Simon-Kucher as a pricing consultant is not the price as such, but understanding the value, understanding what the customer really wants, creating a product which delivers the highest possible value. That's the issue of innovation. And then the last step, communicating the value. That's another big challenge. Because if you think of modern products, complex products of software, etc., how do you communicate the value? And so understanding the customer, creating value and communicating value leads to what we call pricing power. To get the price, to charge the price, you need to make a profit. So the core of pricing is value, not a superficial view of price that you just raise it or lower it. No, you need a deeper understanding of the consumer, of the perception, and how to serve best to integrate technology and consumer needs.
So it seems as though there's two things. There is in a commoditized environment where you have a product that isn't essentially different from others, you might be able to increase price. However, it's going to be constrained by the competitive environment. Equally, on the other side, if you can have a less commoditized product, you gain more pricing power.
Yeah, absolutely. There are always these three forces: the company, your costs, the consumer or customer for industrial customers, and the competition. And of course, you are not living in a vacuum. The competition is there, their products, their prices, their offerings are there. You have to know where your place relative to the competition is. But the challenge is to get away from commoditization to differentiation. And I would say, it's a little extreme, there are no real commodity products because each product has to do with a customer relationship, with a transaction, accompanying service, brand, etc. Of course, there are commodities on stock exchanges, etc. But in normal transaction, even in business to business, there are no real commodities. You may have experience with a vendor. You may be reluctant to take on a new vendor, even if they offer lower prices. So understanding these value drivers is the challenge. Yeah. And it has also an additional dimension, is that you have to quantify it. If we know that our product or our offering is better than the competition's offer, we still need to know, is it 5% or 10% better?
Yeah.
Because that tells us how much more we can charge without losing market share. So it's also the quantification of the difference in value, be it higher, be it lower, which we need to know.
That quantification of value must be the most difficult thing that your firm does relating to pricing, because that's how you determine the pricing, surely.
That's absolutely right. And we have very sophisticated methods. One popular method is, for instance, what we call conjoint measurement, where we do not ask consumers or industrial customers directly how much are you willing to pay for this product, but we confront them with different alternatives of product, brand, etc. and ask them simply to tell us which of the alternatives they would choose. And from these choices, we have a model, a complex model, where we can derive the value of a brand, of a technical features, say of the range for an electric car. We can quantify the value of product and service attributes.
Yeah, which is very easy to get wrong, I suspect. It seems as though many mid-market businesses increase pricing as a response to profit erosion on a random basis. They see the profit go down, so they think, oh, we better put the prices up to compensate. How can a mid-sized business develop an effective pricing function rather than being purely reactionary in relation to profit erosion? Any thoughts on that?
Yeah. It's of course naive if your profit is eroding that you can simply increase the price, because you may fall off the cliff, your customers may go away. The same applies, by the way, for price decreases, because many companies want to increase their market share and they simply decrease the price. They may sacrifice profit, or it may not be effective because they initiate a price war. So you have to understand what the reaction of your customers is. And we call that price elasticity. Price elasticity measures how the customers will react. In theoretical terms, it's the percentage price change relative to the percentage volume change. So say if we increase the price by 5% and the volume decreases by 10%, we have a price elasticity of 10 divided by 5 equals 2. That's, by the way, a typical order of magnitude, around 2. It also means if we cut the price by 5% and the competitors do not react, we may see an increase in volume of 10%. But of course, the price elasticity varies, and it's difficult to estimate. That's why we are using these sophisticated methods. But a simple method is also to have a group of experts, salespeople, managers, and go through a systematic exercise where they estimate what happens if we increase our price by 5 or 10%, or if we cut it by 5 or 10%. The interesting experience from us is that people from the company, so experts, salespeople, managers, have totally different opinions. Sometimes they differ by a factor of 10. Some of them say nothing happens if we increase the price by 5%. Others say if we increase the price by 5%, we will lose 20% volume or market share.
Yeah.
Usually, the salespeople are more afraid, expect more negative reactions of the market to price increases, which is understandable because they have to do the tough job of communicating the prices, and that was terrible under the inflation rates we had in recent years. Many salespeople were really desperate.
Yeah. A beautiful segue into my next question. Most small to mid-sized business owners are fearful to increase pricing as they're worried about losing volume. When you say we need to increase price, to be fair, without a lot of data, but we need to because the costs are eroding the profit, they're worried. They think we're going to lose the volume and then it's going to be almost a doom loop. Of course, salespeople push back on these pricing increases because they think that it makes their job harder, as you mentioned. I think we've both seen that many times. Could you give us your definition of price elasticity and how entrepreneurs, importantly, can overcome this fear?
Yeah, you're absolutely right. Managers are afraid of price increases. They're less afraid of price decreases, so price decrease and cuts are actually even more dangerous because they can initiate a price war, which is the profit killer par excellence. And one way to come around this is to, especially under inflationary conditions, to increase prices more frequently in small steps instead of less frequently in larger steps. Of course, if we look back at our experience in the last 20, 25 years, with the exception of the most recent 5 years, we had very low inflation rates, around 2% or less. This meant you could afford to increase your price only once per year, say by 2%. That was an easy job for the salesperson. He went once per year to the customer and asked for moderate price increase. Now we have had inflation rates in Australia of close to 8%.
Yeah.
It means you have to increase your price several times per year. Every 2 months, I know companies who increase their prices during this period 6 times per year. So the poor sales guy has to come every few weeks, says we have to increase our prices. Of course, the customers don't like that. And so one recommendation is to do it rather frequently in small steps, because that creates a less adverse reaction on the customer side. It's also a way of testing. You are never certain what happens after a price increase, and if you do smaller ones, the risk that a very strong adverse reaction will happen is reduced.
When people say the phrase absorb price increases or absorb additional costs without passing them on, what do you think when people say that? You've spent a career in pricing and profit. What's your reaction? What do you think or feel when it could even be the media, because the media are always in our country talking about how companies need to absorb additional costs. What's your reaction, or how do you feel when you hear that phrase?
Of course, that was a very frequent experience for companies, that they were not able to increase their prices in spite of massive cost increases. What we have seen in practice is roughly the following: that about 50% of the cost increases could be passed on to the customers.
Yeah.
25% had to be absorbed through cost reductions, rationalization, restructuring, etc. And 25% had to be swallowed in terms of profit decreases. So if you are not in a very strong pricing power position, you will suffer under these circumstances. And it's also very different from industry to industry. For instance, in one of our studies, we asked consumers how they react to price increases, and for daily consumer goods, 54% of the respondents said we will switch to cheaper products, we buy less, etc. For tourism, only 16% said that. That was after Corona.
Wow.
People couldn't travel, and so they were really willing to spend money on travel, on vacations, etc. So if you are in these two different industries, the situation is obviously very different with regard to price increase. And for holidays and travel, we have seen major price increases where the price pressure on consumer goods is very, very strong.
Which is what you said, price equals value. The value to a traveller post-COVID who'd been contained
was very high.
Very high. How interesting. What are the most common pricing mistakes that you see entrepreneurs make, and how can they avoid them?
The most common mistake is probably to get somehow into price wars. Of course, who is to blame? We have done many global studies, including many countries with Simon-Kucher, and on the average, 59% of the companies say that they are in price wars with
Wow.
huge differences among countries. For instance, the highest percentage, 84%, we found in Japan. And Japan, interestingly, has the lowest profit margin rate across all industrialized countries.
And do you think that's because the Japanese have a tendency to seek market share first?
Yes, yes. I mean,
Yeah.
I have been in Japan as a visiting professor 1983, or so 40 years ago. And the kind of competition I found there was almost suicidal because they are all driven by market share, by volume. There are exceptions. I mentioned Toyota compared to Volkswagen, where Volkswagen was a guy driven by volume, and Toyota was more reasonable, balanced, profit-oriented. And the other interesting observation is we asked who initiated the price war. And 87% of the companies across the world said it was not us, it was the competition. So they always blame the competition on price wars. Another mistake or a situation which is really ruinous to profit is overcapacities. If you have overcapacities in an industry, it's kind of a hopeless case. I've seen so many industries who were not profitable for years, and then a recession, a crisis came, and the overcapacity was reduced, and all of a sudden they became profitable. And wrong goals. I mentioned Volkswagen. Volume, market share driven goals are another reason. Also, if you are in the wrong industry, there's a term in economic theory, empty core. Empty core means that you cannot make money, or the whole industry cannot make money. Airlines is a typical case. Airlines have been around for more than 100 years. If you look at the cumulative profit over these 100 years, they have not made a profit. No. But still, airlines is such an attractive business for some people. I wanted to become a jet fighter pilot myself, so I am a fan of airplanes, etc. But from an economic point of view, airlines are a hopeless case.
Yeah.
That does not mean that an individual airline, which has lower cost or some special competencies, is not profitable. But the industry as a whole has an empty core. And if you are in such an industry, it's also very, very difficult to make profits.
Yeah, you've got to be pretty lucky. I look at the way they try to differentiate with frequent flyers and special clubs and a lot of those type of things, and they're effective to a degree. But like I said, they've got an empty core, the business. So if you've got a business, or you find yourself in a business, hopefully not airlines, where it has an empty core, is there any thought? I mean, does that mean you've got to find another industry? You've obviously got to work as you can to find profitable differentiation that meets the customer's need. But is there any kind of thoughts or reaction to that?
I think the best way is to diversify. I'm in general against diversification, but if you are in such a hopeless case, it's better to look for another industry.
Let's switch gears to inflation. So I heard you in the last 6 months say that you believe inflation would sit around 5% for the next 5 years. Now, maybe your perspective's changed on that. Maybe it's the same. What are your thoughts on this now, and what are the factors that are driving this prediction?
The basis for my prediction is the experience from the 1970s. In the 1970s, the first inflation wave was introduced by the oil shock in 1973. And then inflation receded for a couple of years and came back again in the late 70s, early 80s, actually to a higher level. And there was a second oil shock in 1978, but the main driver were wage increases. And we see the same pattern today. The prices have gone up, people complain about prices and ask for higher wages, and we see very high wage increases, and I think that these wage increases will lead to higher inflation again. And we see that already. I mean, also in Australia, we have a slight uptick in Europe as well. It may take 2 or 3 years, and the 5% may not be exactly the outcome. But I would say between 4 and 6%, if not higher, is probably realistic for the next couple of years. But I cannot time it precisely. So the main experience is from the 1970s, what we have seen there, and we see the same driving forces, wages with high increases right now.
We're definitely seeing that across our customers. Today, there was a government report out that said that unemployment is stuck at 4%, and we're definitely seeing a lot. Many of the conversations that we're having are talking about the new high watermark for wages that seems a bit outrageous. So it kind of, at a very anecdotal local level, it feeds into what you're saying. But for entrepreneurs, there's a book that you wrote called Beating Inflation on this topic. I cannot encourage entrepreneurs, if that's the case, if your prediction proves true based on experience, to read that book. Because if we're sitting at 4 to 6%, you need to be able to manage your business through that. And it's such a great and practical book. And the problem is there are very few people who are still in leadership or management or thought leadership positions from the 1970s who can offer that advice at a practical level adaptable to today.
Yeah, most of the people who are in charge today did not experience the inflation in the 1970s. I still did that. I actually wrote my dissertation on this topic 50 years ago. And I mean, it's very simple. If you think that the average profit margin, net profit margin, is about 4 or 5% across industries. It varies from industry, it varies from country to country, but that is the average. And then if prices and costs go up 4 to 6% and you cannot pass on the cost increases, this is going to eat up your margin. Very, very simple. So you have no choice. You have to get your prices up. And that's what we call, in the outcome, we call inflation.
Yeah.
It's absolute necessary and rational behavior on the part of companies. It's painful for the consumer, but it's unavoidable if the cost drivers like wages or raw materials or whatever it is go up. And another point in the current inflation rate is that the oil and energy price actually have gone down, which dampens the current effect. If they come back to a level of 2 years ago, which I don't know, nobody knows, of course, that could be another driver of the inflation rate.
Yeah. You just think about inflation hitting your business at, I'll say the average of between 4 and 6 equals 5% for year, and then the next year and the next year. It's something that companies need to consider now. When we're in a period of inflation, what strategies can companies employ to adjust their pricing without losing customers?
I think the main way to cope with this is, again, to look at the value side. Can we offer additional value? Of course, innovation plays a role, but service can play a role in order to induce our customers to accept a higher price.
Yeah, which is...
That is the main way. Of course, the sales force plays a role. Also, the timing plays a role. We should not wait too long. We should rather preempt the inflation in our pricing, because if we wait too long, a year is easily lost.
Yeah. You've Thank you. You've written extensively. You've written extensively about hidden champions, which is are fascinating, both in Germany and in China and across the world. What can entrepreneurs learn from these hidden champions about effective pricing and global competition?
The hidden champions are mid-sized and small global market leaders which are not known. And behind that is a different perception of the world. When you ask people what is the economy about, they say automobiles, big airplanes, telecommunications, so they think only of the big markets. But in reality, we may have 100,000 separable markets in the world, and 99.9% of these are small markets. So each of these small markets gives a company the opportunity to become the leader or one of the market leaders there. And the foundations of the Hidden Champions strategy are three factors. First, the ambition to be the best in your market. Many of these companies state that explicitly. How do you become the best? Only by focusing. Only focus leads to world class. But focus has a disadvantage. It makes a market small. How do you make it large? By globalization. Let me give you an example.
Please.
A company called Flexi, they make these flexible, retractable dog leashes. So a simple product, but it's only simple on the surface. They have the ambition to make the best dog leashes.
Okay.
They only make these products in variants. They say we only make one product, but we do it better than anybody else. So that's a small market if you do it only in Germany. How do they make their market big? By going into the world, they have 70% global market share. And they have been attacked by many Chinese companies. They are selling their products in more than 100 countries. Yeah. So ambition to be the best, focus, only focus leads to world class, combined with globalization. That is the foundation of the success of the Hidden Champions. Many of them have global market shares of more than 50%.
Wow. I've got to say, I didn't think that you were going to give me an example of a retractable dog leash. That is, that's something else. Because I would have thought that dog leashes...
I can also give you more sophisticated examples.
Oh, no, I love it. The simple is beautiful. Because
For
I would have...
instance,
Please
probably
do.
the most sophisticated, far beyond rocket science, is what you call extreme ultraviolet lithography. And these are the machines on which the ever more miniaturized chips are made.
Yeah.
And the two key components there are the laser, which comes from Trumpf, a German company, and the optical system, which comes from Zeiss. And just to give you two or three numbers, the Trumpf laser creates 220,000 degrees temperature on the ship, 220, only for the millions of seconds, shoots 50,000 tint drops per second on the ship, and consists of 450,000 components. The Zeiss optical system is even more complex. It places 56 billion transistors on the surface of your thumbnail. 56 billion.
Wow.
And it took 22 years to develop this. These are hidden champions, and it's a fascinating topic. And my newest book on this is here, Hidden Champions in the Chinese Century. So for small and mid-sized companies, I can only recommend this Hidden Champions. I applied it myself for Simon-Kucher. Yeah. We are the best in pricing. We focus on pricing, and we globalized. So I applied it one-to-one, and it worked. Our revenue last year was $578 million. So mid-sized, not as big as McKinsey, but still not
But you own a
insignificant.
niche. You own that. That's what's important.
Yeah,
Just like the
niche.
retractable
Yeah.
dog lead
Yeah.
manufacturer to another degree, you own the niche, and that's
Yeah,
the
but if we had
riches.
stayed in Germany with the niche, we would have 50 or 100 people and not 2,200. By combining the niche, the focus with globalization gives you unlimited growth opportunities.
Thank you. My next book that I'm writing is called Bigger Isn't Better, Better is Better. So a bit like the Japanese we spoke about earlier, rather than focusing on becoming bigger at every turn, focus on building a better business. How would you define a better business? What's your definition of a better business broadly?
I would consider survival as a very tough criterion. And most companies, especially startups, are very short-lived. And the hidden champions have an average age of 71 years. Even many of them were founded before the First World War, so are more than 100 years old.
Wow.
And I think the topic of your book is extremely relevant and fascinating. I just read a manuscript of an American guy, Dave Walton, and the title of the book is On Companies Which Last and Last and Last. He calls them evergreen companies. So
He's from the Tugboat Institute, right?
He is from the Tugboat Institute. I just gave a speech there a couple of weeks ago, so you know him.
Yes.
It's fascinating, and all these concepts are hidden champions, evergreen companies. What Jim Collins wrote about Built to Last. That is the opposite of what Dave Walton calls big fast, which is the management philosophy. And I was just recently in China together with a colleague from Korea, and he was asked, what is the difference between the hidden champions concept, or you could say the companies which last, better is better, and the American prevailing management paradigm. And he said in America, big, fast, extreme successes are admired, and the people behind it. Steve Jobs, now Elon Musk, Bill Gates. And the German hidden champions model is very different. These companies are not spectacular, but they grow continuously, they become global, they stay focused, so they usually don't go public or take on too many capital from outside, but build their growth on cash flow and equity. And 80% of them are family owned. Of course, a big challenge there is the succession. So it's a very different model, which is admired in the United States and which is the core of some other countries. For instance, in Germany, so our strength is the Mittelstand, the mid-sized sector. We have some big companies, but the real core of the German strength, and we are the number 3 economy in the world with only 84 million people. We overtook Japan last year even.
The first thing that you said is you've got to survive, and I love that. It's essential. What is a book that you would recommend for our audience?
I recommend a very old book. You mentioned several times Peter Drucker, who was a late friend, a good friend of mine. I actually missed him by one day. I had an appointment with him on November 12, 2005.
Oh.
He lived in Los Angeles. The day before, I was in Mexico City. In the evening, I called his home. His wife answered, and I said, "Is the appointment tomorrow standing?" And she said, "He died this morning." So I missed him by one day. And I would recommend his autobiography, Adventures of a Bystander. A fascinating book, beyond pricing and market share, but a book which really provides you with very valuable insights on what management is about. Adventures of a Bystander by Peter Drucker.
Excellent. Adventures of a Bystander. I don't have that, but I am going to buy it today. I love that.
Worth reading, yeah.
Yeah. How can people learn more about you and your business?
Yeah, you already mentioned my own homepage, Hermann Simon, in one word.com. Then, of course, Simon-Kucher.com is the homepage of our. We are also in Australia. Obviously, we have an office. We have had an office in Sydney for almost 20 years. And a special recommendation would be about myself. This is my autobiography, Many Worlds, One Life, where I describe my own entrepreneurial journey from a farm boy to the global stage. That's the subtitle. Yeah. So Many Worlds, One Life. I also describe our business model at Simon-Kucher. We are unique because we have an internal share market where we have 200 partners, 2,200 employees, and 200 partners who own the company. I still have a very small share. My goal was, that leads again to survival, to create a company which does not experience the usual fate of a consultancy. The usual fate is the following. The founder or the founders keep as many shares as possible, as long as possible. Then all of a sudden they are 55 or 60, and if the company is successful, the younger partners cannot afford to buy it. Then instead of price.
Sorry, Hermann, I had this conversation with someone only yesterday.
Yeah.
That's remarkable.
Yeah. 98% of the consultancies are sold to a larger corporation and lose their identity. My goal was to keep us independent. I started very early to give shares to younger partners, and since more than 20 years we have a model where senior partners can sell, younger partners can buy, and we have an external stock exchange, you could say, which we run one per year, so there's no negotiation about pricing, no hassling. We define a price interval. The senior partners say how much they would sell at certain prices. Non-senior partners say how much they would buy. We have an intersection of demand and supply curve. And that has worked wonderfully. And so I am very optimistic that we remain independent and are not sold to Accenture or EY or whoever.
That's fascinating. Thank you for sharing that. That wonderful
and
gem.
I describe that in some detail in the book, and also our approach to focus on pricing and profit. So our strategy is laid out there, and obviously it has worked.
Thank you.
There are not so many companies founded by a former professor who have now more than 2,000 employees and almost $600 million in revenue.
Indeed. Hermann, what haven't we discussed that you wanted to cover off today?
Maybe the role of people. If you ask me what is the key to your success, I would say it's people. And people is always the limiting factor. That is especially true for a service company. Last year we opened new offices in Seoul, Korea, South Korea, in Riyadh, Saudi Arabia, and in South Africa. And we need people who build the business there. When we come into a new country, nobody knows us. And sometimes we have people from our other offices who we can send. Sometimes we have to hire outsiders, have to integrate them. And for me, the challenge of management is people.
In my research for our conversation today, one of the things that you said about people on another interview was the fire that burns inside you, you must ignite in other people. It was, I wrote it down, and I just love that, which is what you're saying. You've got to identify the people and ignite that fire. That's lovely.
That's a quote from the famous Saint Augustine, who lived in the 4th century after Christ. And that is the challenge for an entrepreneur. If you are, say, an author or a speaker or an artist, you can acquire world fame on your own, more or less on your own. Picasso doesn't need a big organization. But if you are an entrepreneur, you need hundreds, maybe thousands of people who build your business.
Yeah.
And you have to inspire them with your motivation, your vision, etc. So ignite the fire which burns in yourself, in your whole team, which leads again to the core of the people challenge I just described.
Hermann, thank you so much for sharing your wisdom with our audience today. It's been a pleasure getting to know you, learning more about your concepts directly, and hopefully through our conversation, at least some of our audience are going to take some kind of action on inflation, pricing, and profit.
Thank you very much, Brad. I enjoyed our discussion.
Well, I hope you enjoyed the episode as much as I did. If you'd be kind enough to leave a review for the podcast, that'd be really helpful to other like-minded entrepreneurs, and then we can grow our community. If you want to find out more about our guests, head over to evolutionpartners.com.au/podcast, where you can find show notes and other additional reading. Hope to see you back next week. Until then, keep thriving.